Alrighty then. Well, I'll just kind of hop in, if you will. Then, so there's just a couple of things to watch out for on grouping rentals. You probably won't come across it too often because it really only applies to real estate professionals. And becoming a real estate professional is hard enough in itself. Most people don't deal with too many of them. The biggest things on it is when you have a real estate professional to be able to deduct the losses. So once you're a real estate professional, it makes you on the federal side not subject to the $25,000 limitation on rental losses, and so that's a big bonus. But you also have to meet material participation in those rentals. And so the problem is if they have a lot of rentals, they can get spread a little thin and they may not make material participation individually on each rental. And so therefore there is an irrevocable election to group all the rentals together into one economic unit. And then that allows the hours of participation to accumulate across the board, which then they can make it and then deduct the losses in full. So the big cons against this, so that's the pro, they get a huge write-off. The bad part is that it takes away the ability, so it creates one economic unit, meaning that if you're ever to sell just one of the rentals, that doesn't free up prior passive losses. And so that's a big issue. So in order to free up, so when you make the election to group them, it basically locks up all of those prior passive losses in prior years and holds them there. I mean, they'll still offset passive income, but in order to free them up, like when you sell a rental and there's a big passive loss that's been carrying over year, it allows that loss to be freed up against ordinary income. And so I've got a lot of high income taxpayers that definitely benefits based on the fact that those prior rental losses from the prior years get deducted against ordinary income, which is generally 35 or 37%. And then they're only paying tax on the capital gain. So you need to make sure that the clients are aware of that it could have negative repercussions down the road. And I actually had it in audit for real estate professionals on a partnership. They had a partnership that was it was a partnership that was doing the real estate, and so one partner elected. So what happened was through the course of the audit, they did not meet real estate professional, unfortunately, on their personal returns. Just so you know on that, I've been through audit on it. It's a nightmare. They do want contemporaneous records. They pick the hours apart very meticulously to try to disallow that. And so what happened was they lost the real estate professional exemption, but my client, we didn't group the rentals. So one of the rentals that sold, it freed up all the passive losses, which offset some of the other gain by the disallowed real estate professional. So it was kind of a wash. The other client, which I did not do the taxes for, he had grouped his rentals on his personal return. And so the sale of one didn't free up his passive losses because he would have had to have sold all of his rentals in order to free that up. I'm going to go ahead and go to the chat here. Looks like a couple of questions popped in. That rep is using Schedule C. Is that not? Can you do multiple groups? Well, Tiffany, they would have to form it as a single member LLC if are they using Schedule C for the rentals?
If they are a rep, they can use Schedule C, right?
For all the rentals.
Yes, but do they have to set up a single member LLC or it's just more like sole proprietor?
Well, no, even if they're a real estate professional, the rentals can still go on Schedule E.
Correct. Okay, that's what I was trying to do. And so you were saying about how if they saw something, but then it's part of the group, they may not be able to write take the passive loss. So
Correct.
conceivably they can set up more than one group then, right? And two different schedules C? Or
No, well, so they have to group all the same economic unit. You can't
oh,
just create several different groups of the same economic unit.
okay, okay. Okay,
Yeah,
great. Thank
it's
you.
not that detailed, but you got to keep your economic unit separate, which is by like commercial versus residential.
Oh, okay,
Um,
great.
yeah, and then we'll get into, and then after this, we'll go over Schedule C versus Schedule E on rental as well. Here,
Darren,
yes,
from what I understand, short-term rentals are not allowed to be grouped. That's
correct,
correct, right?
correct. They're separate because they're already going on Schedule C. There would be
Short
no
term.
reason. Correct.
Okay.
Well, if they make it, if they make the qualifications to be full short-term rental that's operated like a business going on Schedule C. And time to file to Mendel, superseding return. I don't believe, can you group on an amended? You can do it on a superseded return because a superseded return is it replaces the original return. Let's see, there's actually a court case on that. Qualifying, filing late. So you can do it on an amended return, but it's considered a late election on an amended return. And so there is a whole protocol of information that you have to provide for it, and reasonable cause as well. And so there is an article in the Journal of Accountancy on it to aggregate rental. Oh yeah, I'll put this link in here. And so this is in the Journal of Accountancy, and this is how to do it on an amended return and the additional information that you have to provide. And superseded return would be fine because that's considered an original return. And superseded return is basically when you file an amended and as far as sorry guys, superseded replaces the original because it's filed by the due date of the return. And so yeah, so and also to do it on the amended, they would have had to file consistently with having made an election to do it. And so they would have had to have already been filing that way. You're correct, Emily. And so yeah, we can back that one up. No, original due date of the return, yes, includes extensions. Yes, superseding return includes extensions. And so I'm actually in a battle right now on one where the IRS disallowed a superseding return because of the change. Well, they disallowed it. I think it was based on the computers. It was during one of the COVID years. I don't have it right in front of me, but anyways, we filed it on like May 15th, but it was when the due date was July 15th. And so they came back and said we couldn't. They basically disallowed what we did. And so I've been fighting it out with them for about a year. And so on that one, so you got to be careful with the superseded returns as well. It's great that you can electronically file them now. That way they just get in and they're marked and everything. This one we had to do by paper. And one of the reasons on that, and also with that one on the superseded return, was because there wasn't an extension filed because we had filed it before the original due date, so there was no extension. But the IRS computers do not see it that way, so we're trying to get it into the right hands. But yes, Reva, it does include extensions for superseding return. And then Emily was correct. And then with that there and that there. So any questions? And then real estate professional, I think everybody's clear on that. The 750 hours, over 50% of your income. It should be pretty cut and dry. The big thing is making sure your client's aware of all the documentation to document the hours to show that they did spend that 750 hours. That's what the IRS does go through. In my rep example, what do you think triggered the audit? Are there obvious red flags? Yes. So interestingly enough, it was a partnership return, and the big red flag on it was because they were operating it like a business. So sales price, and then we had the cost of goods sold, and so but it was real estate activity, and the IRS found issue with it that there was cost of goods sold on a real estate business. And so but they were flipping properties, so it was 100% for profit, and had cost of goods sold and everything. But this was also, it was 2005 when that audit happened. And so but they did go through their records just with a fine-tooth comb. Okay. So any questions there? Real estate professional or grouping? All right. So those are the big things to be aware of. And to get ahead of it, any specific questions on Schedule C versus E for short-term rentals? Okay. All right. Everybody's doing well this morning. And so just to go over some of the basics on short-term versus long-term rentals. As far as most of the short-term ones, outside of if they're running a motel or something like that, that's super easy and doesn't have much of an issue. But when you're getting into Airbnbs and everything else, on if they can put it on Schedule C, obviously they want to, because there's no passive activity loss limitations or anything like that, and they can take the loss in full. And so on that, your big things is that rental period has to be either 7 days or less, and then or has to have 30 days or less with significant services. Significant services is the tough one to meet because it does fall down to like daily things that you have to do for the people. So substantial services includes cleaning the rental while it's occupied, concierge services, which would be like setting up reservations for them, things of that nature, guest tours and outings, meals and entertainment, transportation, or other hotel-like services. So if they're over 7 days on rental but under 30, then they got to provide the substantial services, which usually like a bed and breakfast or something like that will cover it. But it's usually kind of hard to make it. That's why I usually get the biggest argument with clients on the Airbnbs is if they're providing the significant services or not. And so that's where it gets tough. And then also they have to spend the 500 hours in the activity actually doing it under audit. That's under examination, so they would need the logbook on where they spent the 500 hours actually doing things for the rental. And so let's see here. If number of rental properties are grouped for QBI when one property is sold, where they lost potential. The QBI deduction is different. That's not the aggregate grouping for real estate professional. So QBI, if you group them together, my understanding is it does not lock up the passive activity loss. QBI is just for the QBI deduction. Does everybody agree on that, or does anybody have anything contrary as far as the QBI election goes? It's a different election, in which it has to be made each year, as opposed to the aggregation grouping for real estate professional to treat them all as one. That's irrevocable once you make it. Julie's on the same page, so that's good. And then with that there. Okay, and are you guys seeing the same thing? I'm seeing less and less Airbnbs. Would everybody agree there? It seems to kind of be dying out a little bit. I got to be honest, even on that token, it's become such a pain in the butt. The fees are so much on it. My wife and I last couple of times have stayed at a hotel rather than at a Airbnb because it's just easier.
I've also heard people selling them because they say it's too much hassle, like keeping up with them, the maintenance.
Yep. And so, yeah, the maintenance, everything else. And that's where, and if they want this deduction, having that, participation in it and doing all of these things for the people, it takes up a lot of time. And it's time that you got to put in if you want to write off the loss. So it's really communicating that to your clients as well. That like, you don't get anything for free. You got to put the time in there to get it. And so, but yeah, with the market being saturated, I'm seeing less and less and less of them. Oh, there you go, Julie. Yeah, seeing people build ADUs and put them on Airbnb and VRBO. And so, yeah. And yeah, with a lot of them anymore, there's so many fees, and then you're scared to touch anything and everything else. I remember we stayed in one up in Oregon, and they tried to say we stained one of their towels, and then they tried to come back after us for money. It's like, well, we didn't. And but the whole thing was just weird. And so it's kind of nice just stay at a hotel where you pretty much do whatever you want except set it on fire, which is a lot nicer.